Okay, last thing that has to be done. We've done the adjusted trial balance, we prepared the income statement, statement of owner's equity, and the balance sheet. Now we have to prepare journal entries to close the temporary accounts and post these to the ledger, and then do a post-closing trial balance. So let's tackle one thing at a time. I have my revenues and expense accounts that have to be closed out into the income summary account. And I've got all my accounts right here. So I did this in order, chart account order. So my revenue account is going to be right here for commissions, and all my expense accounts are going to follow right after, boom, 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 just like that, one right after the other. So that my closing journal entry is going to wind up being pretty straightforward. Now, my commissions earned is a credit balance of $9,750. I had to get rid of that by zeroing it out, so I had to do a debit over here for commissions earned to get a zero ending balance. So my journal entry is going to wind up being a debit to commissions earned, for the total of $9,750. And then the credit side of that will go to income summary, because what I'm doing is I'm closing out my revenue into the income summary account. Okay, that's the first journal entry I have to do. The next journal entry, I got to close out all of my expense accounts here, 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 here. All of them have to be closed out into the income summary. Now they're all debit balances for expenses. So if I have to close out each individual expense account, I have to do a credit journal entry for the ending dollar amount in the expense account, and a credit for this one, and a credit for this one, and a credit for this one, a credit, so on and so forth. And then the debit is going to go to income summary. So debit income summary. And I'm going to wait on that one because I got a whole boatload of expenses that I need to list. So I'm going to start with depreciation expense. I'm just going to jot these down real quickly. So depreciation expense followed by salaries expense, and I'll abbreviate the heck out of this, but just understand that I'm doing this for brevity. Next comes insurance expense, and then after that rent expense. All of these are credits to the expense accounts. Next is office supplies expense. Next, wait a minute, I do have depreciation expense. Jiminy Christmas. That should not be in here. Phew, my word. Starting to lose it here. And nobody said anything about it either. Nobody pointed it out to me. Hey, Mr. Hamilton, you got a mistake there. Okay. But I caught it. Thank goodness I did. Okay. Anyway, moving forward. Then I have repairs expense. Then I have telephone expense. So I'm then going to record all of these. So depreciation, 500. This is a pitch when you're lefty, isn't it? Let's just flip this over here like so, I'm not crossing my arms like that. Okay, let's go with this one. Alright, so I had depreciation, salary expense 3620, credit, insurance 133, rent 1800, office supplies 400, repairs 350, 750 telephone expense, and then I'm going to put the total of all these over here, and total comes out to be, see, drum roll, 7553. Now if I were to do all this and update all this stuff, I would then have 9750, and then ending 0, I'd have a credit of 500 here, 0, I'd have a credit of 3620, 0, credit 133, 0, credit 1800, 0, credit 400, 0, credit 350, 0, credit 750, 0. My income summary would be updated also. I'd have a credit of 9750 and a debit of 7553. Okay, this is my revenue, this is my expense. Thus the name revenues expense is equal to net income, thus the name income summary. So I could go back to my income statement and take another look at that and see what my net income came out to be, or I could just simply calculate this out. So 9750 minus 7553 is 2197. Let me just double check real quick. 2197, that was my net income. Good. I am set. So next, I have to close out my income summary and zero that out into my capital account. That's the next step. I gotta zero this out and put that into my capital account. So this would be a credit balance because credit's higher than a debit. So I'm going to do a debit entry for 2197. Debit here and a credit here for 2197. And what that does effectively is zero out my income summary. So my journal entry is going to be a debit to income summary. I kind of did it backwards, but you know, sometimes that happens. 2197 and a credit to Nozomi capital account. Alright, so I closed out my revenues and expenses into the income summary. I then turned around and closed out income summary to the capital account. Next, I have to close out my withdrawals and put that into the capital account. So I will have to do a credit of 1500 to zero this out and a debit of 1500 to put it into the capital account. So my next journal entry is going to be a debit to capital account for 1500 and a credit to withdrawal account for 1500. So I've zeroed out all my revenues, all my expenses. I zeroed out the income summary. I zeroed out my withdrawals, and everything got dumped into my capital account. So now my capital account, I will calculate the ending balance on that because I said I was going to wait on that for a bit. So now let's go ahead and finish the job here. 50,000 plus 2197 minus 1,500 is equal to 50,697. Oh wait, does that number look familiar, guys? 50,697. It should. Let me pull that out again. Remember when we did our income statement, statement of owner's equity, and balance sheet? Okay, 50,697. What is this right here at the bottom of my statement of owner's equity? 50,697. Oh my goodness sakes, it's the same dollar amount. Yes, of course it is. This is my new ending capital balance right here, 5697, and there it is, 5697. Okay, so when we do the closing, you could actually see 2197 was my income, which I closed out from the income summary account. The 50,697 is my calculated ending balance on my statement of owner's equity, which is my new capital balance, which fed into my balance sheet. Okay. Alrighty. So those are some things that you can look at just to make sure that you're on the right path. And then last but not least, we have to prepare a post-closing trial balance. Okay, I'm going to show you what that one looks like. That's a very interesting one because it's a very short one compared to all the rest we've been looking at. Let's see where that went. Here it is. Here's my post-closing trial balance. So I want to point something out to you guys. Here's my worksheet. Let me put this worksheet here and see if I can put this in here so I can point to both of them at the same time. We have on the post-closing cash, accounts receivable, office supplies, prepaid insurance, computer equipment, accumulated depreciation, for computer equipment, yeah. Then salaries payable and the Nozomi capital. That's it. What is all this right here? This are the assets. This is liability. And then Nozomi, this is my equity. This is exactly the same stuff that you'll see in the balance sheet. It's not going to be calculated exactly the same way. This time we're looking at it as far as debits and credits are concerned. But if you look up here on my worksheet, here's the dollar amounts. 27,000, 1,750, 600, 2267, 20,000, 500, 420. The only difference is the capital. But that 50,697 was the same thing that I had calculated over here, the 50,697, which is the same thing that was calculated right here, 50,697. And so now my post-closing trial balance is 50,697, all the same dollar amounts. Okay, folks, is this as easy as falling off a log? Yes. Is it busy? Yes. Are there a lot of moving parts? Yes. But if you wind up being doing it slowly, doing it carefully, checking your numbers, and don't be in too big of a rush, you can make 100% on this. This is not that hard. Okay, it just looks intimidating because there's a lot of moving stuff. Okay. Alrighty, we are done. Thank you very much for your time. You guys have a good one now.